Nobody rang a bell. No emergency meeting was called. Wall Street didn't panic. The dollar didn't crash. And that's precisely why it matters. Earlier this year, 23 nations agreed to expand trade arrangements that increasingly allow transactions to occur without first passing through the US dollar. The headlines were modest. The coverage was limited. Most people never heard about it. Yet if you want to understand where the global financial system might be heading over the next decade, that event deserves more attention than many market rallies that dominated the news cycle. Because this isn't really a story about currencies. It's a story about options. For decades, the international financial system has operated with a remarkable level of concentration. Energy contracts, commodity settlements, international loans, central bank reserves, shipping finance, cross-border payments. The dollar became the common language connecting them all. That dominance created enormous advantages. The United States could borrow more cheaply. American financial markets became deeper and more liquid than any competitor. The dollar's role reinforced itself. People used it because everyone else used it. A powerful network effect. And for a long time, there was no serious alternative. But something changed after the global financial crisis. Then something changed again after 2022. We'll come back to that second date later because it sits at the center of this entire story. For the moment, focus on a simpler question. Why would countries want alternatives if the dollar system works? The standard answer is politics. That's partly true, but I think economics explains more than most people realize. Imagine you're a manufacturer in Brazil buying machinery from China. Neither side is American. The goods aren't entering the United States. The financing may not involve American banks. Yet historically, the transaction often passed through dollars anyway. Convert reais into dollars. Move dollars across the system. Convert dollars into yuan. Complete the purchase. That process works. It also creates costs. Conversion fees, exchange rate exposure, additional financial infrastructure. Now multiply that by millions of transactions. Suddenly, the issue looks less ideological and more practical. Countries aren't necessarily asking, how do we overthrow the dollar? Many are asking something much narrower. Why are we paying extra to use an intermediary currency when both parties would rather transact directly? That's a different conversation, and it leads to a different conclusion. One of the easiest mistakes in geopolitical analysis is assuming every effort to reduce dollar usage is evidence of imminent dollar collapse. The data doesn't support that, not even close. According to IMF reserve statistics and international payment data, the dollar remains the world's dominant reserve currency and the primary settlement mechanism for much of global trade. Its position is still extraordinarily strong, stronger than many critics admit. But strength and permanence are not synonyms. A bridge can be structurally sound while engineers quietly design alternate routes. The existence of alternatives doesn't prove the bridge is failing. It does tell you something about how people are thinking. That distinction matters because discussions about de-dollarization often swing between two extremes. One side insists the dollar is finished. The other insists nothing is changing. Neither position survives contact with the evidence. The dollar remains dominant, yet more countries are building workarounds. Both statements can be true at the same time. In fact, they are. A useful example emerged from Asia. Several members of ASEAN began expanding local currency settlement frameworks to reduce dependence on third-party currencies in regional trade. Similar discussions appeared across BRICS members and other emerging economies. Notice the language: not replacement, settlement; not revolution, adjustment. Financial systems rarely change through dramatic announcements. More often, they evolve through thousands of boring administrative decisions nobody notices until years later. A central bank signs a swap agreement. A regional payment platform launches. A commodity contract settles in a different currency. Another follows, then another. The process looks insignificant until you step back. And that's where the number 23 becomes interesting. Because this isn't merely about one agreement. It's about what that agreement reveals. Something larger is happening beneath the surface of the global monetary system. Not a collapse, not a rebellion, something more subtle. The question is whether we're witnessing temporary experimentation or the early stages of a long-term shift in how international trade actually works? To answer that, we need to look at the moment many governments began reassessing a financial architecture they had trusted for decades. And that brings us back to the date I mentioned earlier, because after that year, a lot of countries started asking questions they hadn't been asking before. The turning point wasn't a currency announcement. It wasn't a new reserve asset. It wasn't even a decision made by a central bank. It was a sanctions package. When the United States and its allies froze roughly $300 billion of Russian central bank reserves after the invasion of Ukraine in 2022, the immediate objective was clear: apply financial pressure, restrict access to reserves, increase the economic cost of war. Whether you support that decision or oppose it isn't the point here. The point is what other countries learned from watching it happen. Because governments don't only study events that affect them directly, they study precedents. A finance minister in Southeast Asia looked at those frozen reserves. A central banker in the Gulf looked at them. Officials in Africa, Latin America, and South Asia looked at them. And many reached the same conclusion. If reserves can be frozen under certain circumstances, should we have more options? Notice the wording, options. That word keeps appearing, not because countries suddenly wanted to abandon the dollar, because dependence carries risk. Any system does. And the more important the system becomes, the more seriously participants think about backup plans. This is where the story becomes less emotional and more mechanical. Most discussions about de-dollarization focus on ideology. The actual process is usually infrastructure, payment systems, settlement networks, currency swap agreements, trade finance mechanisms, the plumbing of global finance. Nobody gets excited about plumbing until it breaks. Take China's cross-border interbank payment system, or CIPS. Many headlines describe it as a rival to SWIFT. That's an exaggeration. SWIFT remains vastly larger and more important. But CIPS isn't trying to replace the entire global system tomorrow. It's trying to create an alternative route for specific transactions. That's a different objective. India pursued something similar. Following sanctions on Russia, Indian authorities explored mechanisms allowing trade settlement in rupees with selected partners. The Gulf states expanded discussions around local currency trade. ASEAN members accelerated regional payment connectivity initiatives. Brazil and China increased efforts to settle portions of bilateral trade directly in their own currencies. Individually, none of these developments overturns dollar dominance. Collectively, they reveal a pattern. Countries are investing in optionality. Think of it this way. Imagine every airline in the world depends on a single airport. The airport is efficient, reliable, well-managed. Nobody seriously questions its importance. But eventually, airlines begin constructing secondary hubs, not because the primary airport is failing, because relying on one airport for everything starts to feel uncomfortable. That's closer to what's happening in global finance. The strongest argument against de-dollarization remains powerful. The dollar isn't merely a currency, it's an ecosystem. That distinction matters. The United States possesses the deepest capital markets in the world. Treasury securities remain among the most liquid financial assets ever created. American institutions retain significant credibility. The legal system, despite criticism, still attracts global capital. No competing currency currently matches that combination. Not the euro, not the yuan, not any BRICS proposal, not even close. This is why predictions of imminent dollar collapse consistently fail. People confuse dissatisfaction with replacement. Those are different things. Many countries would like greater flexibility. Far fewer are willing to trust another currency with their reserves. There's a reason central banks still hold large quantities of dollars. Trust accumulates slowly, and financial systems run on trust. Yet something interesting appears when you examine trade flows instead of reserve holdings. Trade adapts faster. A central bank might keep dollar reserves while businesses settle more transactions in local currencies. Both developments can occur simultaneously, and increasingly, they are. One underappreciated example comes from India and Russia. After Western sanctions disrupted traditional payment channels, both countries spent months experimenting with alternative settlement arrangements. The process was messy, complicated, often inefficient. which actually makes the story more important because participants kept trying. If alternatives were worthless, they would have abandoned the effort. Instead, they continued building mechanisms, refining systems, and expanding possibilities. That tells us something, not necessarily about success, about intent. And intent matters because financial systems are path-dependent. Once infrastructure exists, people tend to use it. Once usage increases, institutions improve it. Once improvements occur, adoption becomes easier. The cycle reinforces itself. We've seen this before. Remember the 23 nations from the opening? At first glance, the agreement looks like a collection of technical arrangements buried inside trade policy. The deeper significance is what it represents. A growing willingness among governments to experiment with conducting business without automatically defaulting to the dollar. Not because the dollar stopped working, because technology, geopolitics, and economic incentives are making alternatives more practical than they used to be. There's a dry irony here. The dollar became dominant because it made global trade easier. Now some countries are trying to reduce their dollar usage for exactly the same reason: efficiency. But before we assume this trend points in one direction, we need to confront a problem, a major one. Because the strongest evidence against the de-dollarization narrative isn't coming from Washington, it's coming from the dollar itself. And when you look closely at the numbers, they tell a more complicated story than either side wants to admit. Let's return to the claim in the title. The dollar is untouchable. At first glance, the evidence seems overwhelming. The dollar remains involved in the majority of foreign exchange transactions worldwide. A large share of global trade is still invoiced in dollars. Roughly half of international loans are denominated in dollars. When investors panic, they usually don't run away from the dollar. They run toward it. That last point is important. Financial systems reveal their true hierarchy during crises, not during conferences, not during press releases, during panic. And every major shock of the last 20 years has reinforced the same reality. The 2008 financial crisis began in the United States. Global investors bought dollars. The COVID shock hit global markets. Investors bought dollars. Regional banking stress emerged in 2023. Investors bought dollars. It's a remarkable pattern. The world's preferred safe haven remains the currency of the country where many financial disruptions originate. That sounds contradictory, yet that's exactly what happened, which creates a problem for anyone predicting the dollar's imminent downfall. The evidence simply isn't there, at least not yet. But here's where the story takes an unexpected turn. The dollar does not need to collapse for the global monetary system to become less dollar-centric. Those are entirely different outcomes, and too many discussions treat them as the same event. Imagine a company with 90% market share. 10 years later, it has 70%. It's still dominant. It's still the market leader. It still makes enormous profits. But something meaningful has changed. The direction. That's the reversal. The most important question isn't whether the dollar remains number one. It almost certainly will for the foreseeable future. The question is whether its share of global financial activity continues gradually declining at the margins, because that's where the evidence becomes more interesting. According to IMF reserve data, the dollar's share of global foreign exchange reserves has trended lower over the past 2 decades, though it remains comfortably ahead of every competitor. Importantly, the decline hasn't primarily benefited one rival, not the euro, not the yuan, not gold alone. Instead, reserves have become somewhat more diversified, a little more fragmented, a little less concentrated. That distinction matters because it challenges a common assumption. Many people imagine the future as a contest between the dollar and the yuan, America versus China, one winner replacing another. Reality may be messier. Financial power doesn't always transfer neatly from one currency to the next. Sometimes it diffuses. A larger role for regional currencies, more local currency trade, greater use of gold reserves, alternative payment networks, multiple systems operating simultaneously, not one throne changing occupants, a larger room with more chairs. And this is where I think both sides of the debate occasionally miss the deeper issue. The real story isn't currency competition, it's geopolitical trust. Currencies are downstream from trust, always. The dollar became dominant because governments, corporations, investors, and central banks trusted the broader American-led system. Military power mattered, economic size mattered, but trust was the multiplier. Without it, the system doesn't function. Which brings us to a question I find more important than reserve statistics. Has trust become more concentrated over the last decade, or less? I'm not entirely sure the answer favors concentration. Consider the behavior of governments across the global South. Many maintain strong economic relationships with the United States while simultaneously building deeper financial ties with China, Gulf states, regional institutions, and neighboring economies. That's not ideological, it's strategic. Countries increasingly appear reluctant to place all their financial dependencies in a single basket. The same logic applies to supply chains, the same logic applies to energy, and increasingly, it applies to money. A revealing example comes from central bank gold purchases. For several consecutive years, central banks collectively purchased gold at historically elevated levels. Gold doesn't generate yield. It doesn't power international trade efficiently. It isn't replacing modern finance. Yet governments keep buying it. Why? Because gold has one characteristic that currencies cannot offer. It isn't another country's liability. That doesn't mean central banks are abandoning dollars. Far from it. It does suggest they're thinking about resilience. And resilience is a recurring theme throughout this story. Not rebellion, resilience. The distinction matters. Remember the 23 nations from Part 1? At the beginning, the number seemed to imply a direct challenge to the dollar. Viewed through this lens, it represents something subtler. Countries are not necessarily coordinating against the United States. Many are simply trying to reduce vulnerability to any single financial pathway, whether that pathway is American, Chinese, European, or otherwise. Which leads us to the final question. If the dollar isn't collapsing, yet alternatives are expanding, what does the next decade actually look like? Because I don't think either extreme prediction survives contact with reality. The future probably belongs somewhere in between, and that middle ground may be far more consequential than most people realize. Let's answer the question we started with. Is the dollar untouchable? No. Nothing in economics is untouchable. The British pound once sat at the center of global finance. Before that, other monetary systems dominated international trade. Every financial order eventually changes. But that doesn't mean the dollar is about to lose its position. That's where the conversation usually becomes detached from reality. A currency doesn't lose global dominance because politicians announce a new initiative. It loses dominance when another system becomes more useful, more trusted, more liquid, and more convenient. That's an extremely high bar. The dollar still clears it, by a considerable margin. The United States remains home to the deepest capital markets on Earth. Global investors can move trillions of dollars through American financial markets with a speed and confidence that few alternatives can match. Treasury markets remain enormous. The legal infrastructure remains attractive. The network effects remain powerful. All of that matters. Yet something else matters too. For decades, participation in the dollar system was often viewed as the only practical option. Increasingly, it is becoming the preferred option rather than the only option. That sounds like a small distinction. It isn't. Because financial systems change at the margins first. A bilateral trade agreement here, a local currency settlement framework there, a new payment platform, a central bank swap line, a commodity contract priced differently. Most of these developments appear insignificant in isolation. Collectively, they begin altering incentives, and incentives shape behavior. Think about the internet. Nobody woke up one morning and realized it had replaced entire industries. The process unfolded gradually. One service moved online, then another, then another. At every stage, the old system still looked dominant, until eventually people realized the center of gravity had shifted. I'm not arguing the dollar faces a similar disruption. The comparison is about process. Large systems rarely disappear suddenly. They evolve incrementally. The evidence suggests global finance may be entering that kind of period. Not de-dollarization, diversification. Those words are not interchangeable, and I think that distinction will define the next decade of monetary politics. Here's my opinion. The biggest mistake both supporters and critics of the dollar make is treating this as a winner-take-all contest. The world doesn't need to choose between a dollar system and a non-dollar system. It may increasingly operate with several overlapping financial networks. The dollar remains dominant, regional currencies gain larger roles, gold remains a reserve asset, digital payment systems expand, local currency settlements become more common, all at the same time. Messy, uneven, complicated, which is exactly how most historical transitions actually unfold. But I do have a question. What happens if geopolitical tensions continue increasing while economic integration remains necessary? Because that's the contradiction sitting underneath this entire story. Countries still want access to American markets. They still want dollar liquidity. They still value financial stability. Yet many also want alternatives in case relationships deteriorate. Those objectives point in different directions, and governments are trying to pursue both simultaneously. That balancing act may become one of the defining challenges of the 2030s. My prediction is relatively simple. 10 years from now, the dollar will almost certainly remain the world's leading currency. I would not bet against that. What I would bet on is a smaller share of trade automatically defaulting to dollars than today. Not because the dollar failed, because alternatives became more practical. That's a crucial distinction. Remember the number from the opening. 23 nations. At first, it looked like a challenge to American financial power. By the end of the story, it looks more like a signal that countries are preparing for a world where flexibility has value of its own. And that's the real takeaway. The most important change in global finance may not be who replaces the dollar. It may be that fewer countries feel comfortable relying on any single system forever. That isn't a revolution, it's an insurance policy. And history suggests governments buy insurance when they think the future could look different from the past. The dollar remains the giant in the room. The difference is that more countries are quietly building extra doors. If you enjoyed this analysis, subscribe and join me for the next one. The global economy is changing in ways that rarely make the front page, but those changes often matter the most.